Just wait another minute for people to come in. Good morning, everybody. Thanks for joining us today for our first insurance roundtable. I would first like to thank our sponsors for today. We have McGowan Program Administrators and the Daniel and Henry Company. Joel, would you like to go first? Thank you for sponsoring.
Oh, our pleasure. McGowan Program Administrators, we're a national program specializing, my division is specializing in community associations. Brokers, such as the other three on the panel, may have an opportunity to come to us for our specialized products. That's what we do. We live and breathe it, and we write in all 50 states.
That's great. Thanks, Joel. And then we also have the Daniel and Henry Company. Jim.
Thanks, Kathy. Sure, the Daniel and Henry Company. I'm proud to say we turned 100 years old this month, and we're all very proud. Through a huge party a couple weeks ago, and we have been serving community associations. We know at least about 70 years of that time, and I currently lead the community associations group and provide all the types of coverages that communities need to protect their assets and the trustees. So thanks everyone for attending today. It's great that you're here.
Thanks, Jim. I also wanted to introduce, we have Stephen Davis and Steve Doors. They are both on our program committee, and they're the coordinators of today's program. So Steve's going to tell us a little bit about the SERMs.
Well, welcome everyone to this program today. One thing that's special about the four hosts that we have is they all share the same national designation through CAI. As Kathy said, it's a SERMS, which is short for Community Insurance and Risk Management Specialist. One thing's kind of interesting about this is we do have 3 members that are here in Missouri, and 1 member is national, who's part of our Heartland chapter. That's Joel Meskin. And like I say, I'll list our 4 members here today is Jim Rubson. We have Karen Corrigan, Russell Weber, and Joel Meskin. That makes up the 4 part of Heartland chapter, but there's only 106 SERMS members nationally. So it kind of tells you how hard it is to get this designation, how few have this. But it's one that we're actually very lucky and very fortunate to have, 4 within the Heartland chapter out of that 106 total nationally. Give you a little bit of background on that designation through CAI. To be able to get it, you have to have at least 5 years of experience in insurance in the association industry. You have to be in good standing legally and ethically within the industry. Obviously, there's an application process that we have with any of the other designations. And then in part of that application process looks at your experience, your education, the breadth of everything that you've done within the association insurance industry to be able to qualify through CAI to obtain that SERMS designation. One of the other things that actually the SERMS members had let me know about today is after the unfortunate collapse of the Champlain Towers, there's been a national task force put together, and it has reached out to all of the SERMS members nationally, trying to look at the insurance industry, obviously looking at every aspect of what's gone on with this unfortunate event. And it was told by Joel Meskin, there's 50 to 60 of those 106 SERMS members that are actively participating in this. So you have some of the best and brightest in the industry who are giving of their time and effort and experience into helping, in essence, the insurance industry figure out how can we learn from this and how can we move forward from this. So with that, I'll turn this back over to Kathy.
Thanks, Steve. Now I'm going to have Stephen do the intros of our panel for today.
Thanks, Kathy, and thanks everyone for being here today for this program. Sorry that I'm not seeing all your faces in person, but I just looked over the attendance list on Zoom here while we were waiting for everyone to join. So it's great to see so many familiar names on there and some phone numbers. I can't tell who you are, but that's okay. Thanks for joining us today. We've got 4 panelists, as you've heard today. And I've got bios to give you a brief introduction for each of them here. First is Jim Rubson, SERMS and EBP. Jim is a senior vice president at Daniel and Henry Company. Jim is currently the VP of the CAI Heartland Board of Directors. former president and also serves on the communication committee. Daniel and Henry Company is a 2021 Diamond sponsor for the chapter, as well as a corporate Hall of Fame partner. Karen Corrigan, CERM's EVP. Karen is president of O'Connor Insurance. Karen's late father was one of the chapter's founding fathers. She has served as a past president of the chapter and on several committees throughout her years with CAI. Karen has authored numerous articles for CAI National, as well as the chapter. O'Connor Insurance Agency is a 2021 Diamond sponsor for the chapter, as well as a corporate Hall of Fame partner. Joel Meskin, CERM's CCAL Fellow EBP. Joel is the Managing Director of Community Association at McGowan Program Administrators. Joel has served on the CAI Business Partner Council, CAI National Board of Trustees, and is a founding member of the Foundation for Community Association Research think tank. He has presented in over 33 states and has authored several articles for both chapters and CAI National. Joel is also a fellow with the College of Community Association Lawyers. Russell Weber, CERM's EVP. Russell has been with O'Connor Insurance since 1997. He has served on the chapter membership committee for several years and has earned both his CERM's and educated business partner designations through CAI. So please join me in welcoming these four qualified, extremely qualified individuals to be presenting on this topic for us all today. Thank you to the four of you for being here. And I know if we were all in person, everyone would be giving you a loud round of applause.
Absolutely. Thank you, Stephen. So we're going to save all the questions for the end. It's going to be a panel. So we're going to start with Jim's presentation, and then we're going to move right on to Karen and Joel and Russ. And then we'll save all the questions for the end. We will share with you the PowerPoint presentation at the end. I'll send it out through email. But Jim, we're going to hand it off to you.
Great, thank you. So I'm going to be focusing on property insurance today, and it's budget time. So everyone's trying to wrap up their budgets and figuring out what's going to happen to our insurance costs next year. So I'm going to talk a little bit about market trends. The next hot topic that I'll address is valuation, meaning the replacement or reconstruction cost of the association's assets, buildings, and structures. And then I'm going to go into market trends by community type, because we're finding that by the type of association, the insurance renewals are going to look a lot different. We talked a little bit about the Champlain Towers issue, and all of us here are part of that national working group. I'm going to talk about potential effects on property insurance and some of the lessons learned from Champlain Towers. And then finally, a quick hit on, how do we start reducing these skyrocketing property insurance costs that are really a drag on the budget. Karen, go ahead and flip to the next slide if you don't mind. So what's happening in the marketplace Q4 2021 and into 2022? In short, the property insurance market stinks still. It's not been great for a few years. You can see the top 20 global property reinsurance companies have lost money for at least 3 years in a row. And the global reinsurance marketplace drives, at the end of the day, the end cost for all of us, even your homeowner's insurance. And so reinsurance is the insurance company for the insurance companies. So when you buy a $1 million policy, your insurance company may only be paying the first $100,000 or $500,000, and then they go get reinsurance for large claims and then broad claims that affect many policyholders at the same time to help protect their balance sheets. So what happens when there's a lot of losses in the reinsurance marketplace is it becomes a supply and demand. Global institutional investors aren't putting money into the reinsurance marketplace, and therefore the supply is the same or more, the supply is the same or less. The demand is increasing for that transfer of risk to the reinsurance markets. And you can see the reinsurance renewals, the last 3 major reinsurance renewals, July, January, and then this past July, were up substantially, with July 1 last in 2020 being really a nasty reinsurance renewal. There's some question about the looming impact on global business income claims due to COVID. There's a lot of litigation going on in Europe, especially, that we don't know if that's going to pull additional capital out of the marketplace. To be determined. I think we're a few years down the road before we're going to feel the full effects of that. There are some signs of relief happening. We're starting to see a little bit of capacity come back into some market segments. I'll get into that a little bit later. There is a question mark on the Champlain Towers impact. Again, we're all part of a national working group, and folks on the coast and in Florida are already seeing impacts. I think we're going to be a little sheltered here in the Midwest from it. But again, there tends to be a long tail on these things in the insurance industry. We don't move really fast. And so we're going to keep an eye on that as a group this year and beyond. And then the marketplace is all over depending on the type of community. And again, I'll get into what that means here in a little bit. Go ahead, Karen. Valuation issues. Who here has bid out a construction project recently? A roofing project, a deck project, a siding project? You've seen that prices skyrocketed at the beginning of the year. In some cases, 50, 60% or more. There was a little bit of a lull in some of those prices the last couple of months, and now we're seeing it go back up again. So, and we're hearing supply chain issues in China and here domestically are going to keep affecting construction price costs. And so I think we're gonna see a continued inflation in construction prices. So what does that mean to all of us in the insurance industry and community associations? Insurance companies are paying these claims, and they thought they'd pay $100,000 for your roof a year ago, and now they're paying $150,000. Well, they can't keep profit if they continue doing that. So they need to keep that insurance to value up, meaning that they need to make sure buildings are insured to the value that they should be to actually reconstruct them. So what we're seeing in the current marketplace is, 10, 15, 20% valuation increases, doubled with a rate increase on the rate per $100 of insurance that you're buying. So there's a bit of a double whammy going on. And I know a lot of you have seen that over the last year. 2021 in particular has been a little rough on a lot of renewals, and in the end of 2020 as well. Excuse me, I'm getting over bronchitis, so if I start coughing a little bit, I apologize. Coinsurance. I know we've talked about this, Karen, myself, everyone else talks about coinsurance a lot, but at the end of the day, coinsurance is bad. Coinsurance is the insurance industry's way of mandating that associations carry the insurance to value requirement. And if an association doesn't, they can penalize the association at the time of a loss. And when we have these rapid construction price inflation like we have been, we're really in an acute environment where you could put yourself in a coinsurance penalty situation without even doing anything, just because the inflation is so rapid. So I'm not going to go through the coinsurance example here. You'll all have a copy of this presentation afterwards. But at the end of the day, avoid coinsurance. It's bad. Get agreed value on all your policies, especially in this market. So now I'm going to go through market segments, and there's really distinct issues in each of these. First, I'm going to start with high and mid-rise communities. Monday, I had what will be $1 million water damage claim in one of my high-rise buildings. Massive leak, 42 units affected, 3 commercial units. And everyone else has these stories in the industry with these mid and high-rise buildings. Water damage claims are getting more expensive, and they're happening more frequently. So there's a lot of sensitivity in this segment to controlling how much the insurance companies have to pay. So we've seen a few markets exit and then others tighten underwriting standards. What we're having to do is we're having to add water damage deductibles to mid and high-rise communities, 25 to 100,000. I've got one that's 250,000 because their claims have been so bad. Sometimes it's a per unit water damage deductible. So it's really all over the board. But if you manage or you're a board member of a mid or high rise, just know you can probably expect some level of water damage deductible at your upcoming renewal if you don't have one already. And then we also have insurance to value issues on high rises, especially 7+ stories. We're seeing some rapid valuation increases on some of these buildings. So just something to look out for. Then we've got villa, townhome, garden style. We call them a lot of different things, but this is where the units are spread out and the association insures the buildings themselves. Probably the most challenging segment of the industry right now. And it has been for years. And unfortunately, I think it's going to continue to be for a little while. If you look at this photo here, what do you see? Roofs, a lot of roofs. And in this area, the roof claims just continue. They're not ending. The other thing we're seeing is that this segment of the industry is aging. There's a lot of these things built in the 70s, 80s, 90s. There's been a ton of deferred maintenance. And so we're seeing, communities that were really nice 20 years ago starting to show wear around the edges, and underwriters are noticing there's an uptick of claims. And so it's, especially if there's 20 or more buildings, a lot of insurance companies won't even look at these communities anymore if you have more than 20 buildings, because there's so much exposure to roofs and sidings. The insurer capacity, for these roofs, especially is minimizing. So you're seeing wind hail deductibles are the norm. It might be increasing. The other thing we're seeing is that roofs older than 10 to 15 years old might have an actual cash value clause applied. There might be cosmetic roof exclusions, meaning that if you just have cosmetic but not structural damage to roofs, they're not going to cover it. So again, just keep an eye out for these things. And finally, aluminum wiring. This is a big deal. If you still have non-remediated aluminum wiring, maybe it's time to remediate. We just had a community that was in the non-standard market reduce their cost by 50% by going through and remediating everything. And we were able to get them into a preferred market. That the ROI was less than 3 years to pay for the project just through decreased insurance costs. So it's really something that your communities with aluminum wiring need to look at. And then we got HOAs, PUDs, where the association is not insuring the structures. Single family homes, typically, sometimes villas or townhomes. Relatively stable market here. Seeing a lot of, on the property side, a lot of relatively even renewals, maybe up a little bit. Really watch out for the valuation of your clubhouses and other structures, though, to make sure you're keeping up with construction inflation, avoiding co-insurance. And then the other thing is, a lot of times we see these where there's not a thorough statement of values for the community, meaning that, maybe they got light posts or roads that they're responsible for insuring, or structures that you don't think about. And there's not an asset listing. And if that doesn't exist, or if it's not accurate, it may not be insured accurately. And many times the governing documents require the association insure those assets. So work managers and trustees work with the, go through, create an asset list of everything that really should be insured. All right, lesson from Champlain Towers. So there's a lot going on here. I'm just going to focus on the property side. One of the things that's really interesting with this is the insurance company on the primary property, Great American, paid a check for, I forget the dollar amount. Joel, you can correct me. I think over $30 million or 40, whatever the dollar amount was. 30 million, thank you. So they paid it almost immediately. But the general consensus amongst the CERMS community is there really shouldn't have been coverage here. Collapse coverage is very, it's confusing. So there's two different endorsements or sections of the commercial property policy that typically address collapse. I was told that this phrasing was in the Great American policy. It's called additional coverage collapse. And you can see here that collapse is a covered peril, except when we know that there was decay or deterioration already in the building. Well, the board of this community knew years ago that there was severe decay. And we all think that Great American wrote a check because they wanted to avoid bad PR and litigation. We would not expect this to happen in all cases. Some insurance companies would fight it, and frankly, they probably have a very good case to decline the claim based on what we know today. And so, you know, we don't know exactly, though, how this is going to affect underwriting nationally. We know on the coast, especially Florida, there's a lot more scrutiny on buildings that are 40 plus years old. I would expect that to spread in the future. And one thing that we may need to start looking at for these older communities is going beyond a reserve study and getting a structural engineering report. So if you're the board member or a manager of one of these older high rises, it may not be a bad idea to budget in the next couple of years a structural engineering study to see if there are any decay issues going on. All right. And then finally, for my segment, tips to reduce insurance costs. We really need, as agents, roof updates, all the updates that you're doing. If you're a high-rise, mid-rise building, if you're going in and scoping all of those main lines, if you're installing water sensors, anything you're doing to make your community more attractive to the marketplace is really important to know right now. And in some cases, it's helping us take an underwriter who is going to decline to quote your account and putting them, you know, over to, okay, I'm going to actually compete for your business because this community is being proactive. They're updating roofs, they're preventing water damage claims, and therefore, you know, we want to work with them. If you have a reserve study that is funded, that is being funded, let us know as agents. We're sharing those in many cases. And this, again, could be the difference between getting a quote from a specific underwriter or not, just showing that you're being proactive, and really recommend if there is no reserve study in place, please do it. It's really important to have one of those done and to start funding for the future capital improvements. And then finally, we're seeing this a lot where we really need to shift smaller claims to unit owners. Insurability for the community as a whole is often a lot more challenging than individual unit owners. So those smaller nuisance claims, if we keep racking those up and submitting them to the insurance company, there's a saying in our industry called frequency breeds severity. Meaning if we have a lot of water damage claims or a lot of little dinky claims, underwriters start looking at that and saying, something's going on in this community and we're probably going to get nailed in the near future for something bigger. So oftentimes we're having to take higher deductibles or that per unit water damage deductible or a higher wind hail deductible. We need to communicate with unit owners and ensure they understand their insurance responsibilities and work with their personal insurance agent to prevent gaps between the association policy and the unit owner policy. So that's the end of my segment. I'm here to answer questions at the end. I'll go ahead and turn it over to our next speaker.
That would be me, and I'm Karen. I'm trying to move the slides, but there we go. Okay, so I'm here to talk to you, everybody, about the liabilities of the community associations. Clearly, property is an issue. What Jim said, everything is absolutely on spot. And as far as protecting your community, if you protect the property, you have a good chance that you are also protecting the liabilities. So what I'm talking about today is the general liability insurance, which is different than D&O. It's different than cyber, which Russell is going to speak to. It's different than environmental. It's your basic general liability. And on top of the general liability, we hope everybody has umbrella liability, which will add another layer of protection on top of this general liability. So where do we find coverage in the general liability policy? We also find it in the umbrella, which is really important. But what is covered? It's different than D&O. It's different than what Joel's going to talk to you about. It's different than what Russell's going to talk to you about. It excludes what Joel and Russell are going to talk to you about. So we have to have multiple policies. It includes 3 basic items: bodily injury, which is going to be your slip and fall on the sidewalk, the parking lot, wherever it is; property damage. Let's suppose that an association is having their trees cut down because they've a lot of dead trees, they've aged, but they accidentally also order the neighbors adjacent subdivisions trees cut down. That's property damage. We don't see that as often as we see injury. And then there's a term called personal injury, and this is different than in the legal field. In the legal field, Steve will tell you, personal injury is the same as bodily injury. But in the insurance contract, it's going to be something more like your libel slander. A board member says disparaging remarks about an owner. Or let's suppose that they post in the newsletter who is late on their assessments. Something like that is also covered under this general liability policy. The one area that I think most people get confused upon is who is covered. Well, we have the association covered. We simply say you are an insured. You is the association. But guess what? It goes beyond, and it says your executive officers and directors are insured. So very often I hear the board and the attorneys say, well, if they name the director individually, it should be a claim under the directors and officers policy, and that's inaccurate. It's all about what type of claim it is. If it is for bodily injury or property damage or libel slander, it goes under this general liability policy. And we can see your executive officers and directors. Executive officers means any person holding the officer position. So we do have coverage under this general liability policy for individual officers. So what I really would like communities to understand is what puts them at risk? What are the hazards? Clearly, water features, drownings are the potential problem. Pools, lakes, ponds. I'll show you how walking and biking trails can be an issue. Dog parks. If we have seniors and or children, that's an issue. They tend to get hurt more than just myself. Vegetation, hedges, trees, they're an issue. Security or the lack of security. So, I mean, how does a community association get it right? Do they have too much security? Not enough security? Serial litigants. We have those homeowners that continually threaten to file suit. Disgruntled owners, sport courts, playgrounds, any type of trip hazard, just a sidewalk. If you own a sidewalk, streets, sidewalks, crime can be a liability for the community association, as well as discrimination. We're having parties, sponsored events can be a hazard, as well as providing alcohol. Now, with all that said, we are a community that was developed to provide all these things and amenities and communal harmony. But there's a safe way to do it all, and it needs to be protected. And as Jim said, property reserve studies, the more you keep your property safe and up to date, the less hazard you're going to have. So this is 12 million reasons why we should keep our vegetation and our hedges trimmed. This 80-year-old woman was driving a minivan, and she was coming out of Villas on the Green condominium parking garage, but the hedges were overgrown and a stop sign was not placed properly. And therefore, when a father and son bicyclist went by, she hit accidentally the 9-year-old boy, and he was killed. Now, they say, the experts said, the crash could have been prevented had the hedges been trimmed back and the stop sign was not placed in an appropriate amount of distance from the hedges, and therefore her sight line was impaired. The verdict was that the management company who placed the stop sign was 60% at fault. Villas on the Green was 30% at fault, and the driver was only 10% at fault. This is how our society looks at businesses, and the community association is a business. We are almost always wrong. The business is wrong, and we feel for the injured families. This is an example of a bike trail. This is a multi-use trail, actually. So it's biking and walking. And right here we have 2 bollards. This looks quite innocent, right? These 2 bollards are so that cars don't get confused on the street and accidentally turn here. So they put them up for safety. However, they didn't hire a transportation engineer to consult on where they should go and what type of bollards they should be. And therefore, this man, he was a former SEC official. He sued, and his award was $41 million. He was riding his bicycle behind his wife, and he hit the bollard and propelled forward, and he is a quadriplegic. So the experts, again, testified that this loss could have been prevented. Those bollards should have been painted bright yellow, and they should have been made of a flexible material. However, no expert was consulted when they put them in. They wanted them, the community wanted them to be aesthetically pleasing, and that was a real problem because they found James to be 50% at fault for hitting the bollard, but Jonathan's Landing HOA was 45% at fault. There was an adjacent golf course that got brought into the suit, and they gave them 5%. So the point is, we tried to be safe. We tried to keep the cars off the path, but we didn't do it right. So we have to do things right. As Jim talked about, maintaining our buildings, this created a life safety issue clearly in California, killing 6 people and leaving 7 severely injured when this balcony from the 4th floor fell down onto this balcony. What happened was this soffit that the 4th floor used to have is made of what was supposed to be a water deterring material, but the water penetrated it, and there were beams sticking through underneath in through the soffit, and they were decayed from water that seeped in. And therefore, they just collapsed and let this balcony collapse onto the other balcony. Again, loss of life. California did process some legislation after that, requiring some inspections on certain properties. Again, it didn't help anything from Surfside with the Champlain Tower South, but this type of thing does happen. We have to get some engineering done to prevent life safety issues. Swimming is always a problem. We try to have lifeguards. We try to do it safe. This $16 million verdict came from Kansas City. And this is where an 18-year-old boy jumped off of a dock, but he went off of the side instead of at the end where it was deeper, and it was less than 4 feet deep. And therefore, he is now a quadriplegic also. The damages were that Bradley was 20% at fault. It was initially a $20 million verdict, but we reduced it by Bradley's 20% at fault, so it came down to 16 mil. The association was responsible for 15 million, and then the lifeguard company for 1 million. And it was all about signage. There wasn't proper signage. It didn't say don't jump. It didn't say how deep the water was, don't dive. So this is a type of verdict that we're seeing. Again, life safety. This is a fire in Honolulu, Hawaii in 2017. It damaged 30 units were destroyed and 200 were affected, not to mention the loss of life. There was $107 million of property damage, but the loss of life was devastating also. This gentleman lost not only his brother, but he lost his mother. The building was built in 1971. And in order to retrofit it with sprinklers, it was going to cost $18 million, and the board did not do it. So there was a lot of litigation around this, and it was a confidential settlement. And it was called Marco Polo Condominium in Honolulu in 2017. So with those claims are very, very evident that there's life safety issues, there's a liability situation going on. But for most of our everyday situations, it's not so cut and dry. we get a report of a slip and fall on the sidewalk, gumballs. They fall over the gumballs from the trees on the sidewalk. They slipped on the ice on the parking lot, but we're just not sure if it's going to turn into anything. Nobody's come to us and asked for money. Nobody's said, we blame you, but we know it happened. So when do you report this to your insurance company? This is ISO language. That means Insurance Services Office wrote this type of policy. They write the template for the language in the industry. And it says in almost every policy you're going to see out there, duties in the event of an occurrence, offense, claim, or suit. You must see to it that we are notified as soon as practical of an occurrence or an offense, which may result in a claim. If it may result in someone claiming damages 2 years later, your insurance company shall be put on notice according to the conditions of the policy. What is an occurrence? It's simply an accident that it could also be including continuous or repeated exposure to the same condition, but it simply means an accident. If an accident happens, the insured's duty, and when I say insured, I mean the community association's duty, is to make sure that the claim gets, even if it's a potential claim, that it gets submitted. And I do want you to understand that telling your agent about it and asking for some advice does not constitute submitting a claim to the insurance company. If you call me and talk to me about it, I'm going to tell you your duty under the claims process in the policy is that we submit the claim to the carrier. If you do not submit the claim to the carrier and 2 years later there is a lawsuit or something comes of it, the carrier can call the policy and the coverage null and void because they can deny the claim based on late reporting because if you prejudice their opportunity to investigate. So out of that, we have some do's and don'ts. We do want you to understand what may result in a claim. So it's sudden and accidental injury or property damage or personal, libel slander. We don't want you to wait for a lawsuit. Nowhere in the policy does it say a claim is a lawsuit. It is simply an occurrence, which is simply an accident, not a lawsuit. We do want you to call your agent and ask the incident is reported as a claim to the insurance company. Even if nothing's come of it, we want to make sure that it gets reported properly in case something comes of it. We don't want you to mistakenly think that telling your agent is reporting the loss to the insurance company because it's not. We want you to realize that the general liability policy also covers individual directors. So if we have an injury situation, a life safety situation like we did at Champlain Tower South, that is not only a property claim, but it became a liability claim because I'm sure that some individual directors are being named and they can have defense under the general liability policy. The general liability policy in their case, which we'll go into, actually already paid out limits. But don't confuse a general liability claim as a director's and officer's claim just because a director is named. We can still submit it under the general liability policy. A little bit about Champlain Tower South. Jim hit on this also. We're on the task force. What we do know is that $30 million was paid out by Great American on the property insurance. They had $30 million limit on this building. This is what it looked like afterward. $30 million isn't going to go far for that. To Jim's valuation point, was it properly evaluated? We don't know the answer. 4 days after the loss, James River Insurance Company wrote a letter to the receiver and said, we intend to tender our $2 million general aggregate limit to Champlain Tower South, no questions asked. Obviously, clearly there was loss of life. Clearly they would kill that $2 million limit instantly. But what's a little bit unique is that the $1 million Philadelphia directors and officers liability policy also said, we're going to tender our $1 million. Well, as I tried to explain, loss of life, bodily injury shouldn't fall under directors and officers. Joel's going to explain what directors and officers can pay for. However, it doesn't pay for bodily injury. However, they could turn their allegations into failure to properly reserve or something like that. So Philadelphia just said, hey, if we cut our $1 million check, we no longer have any obligation to defend, we're out of here. Same with James River. Once they issue policy limits, there's no longer an obligation to defend. So then we also know that their umbrella, we talked about umbrellas having to lie over this, their umbrella paid out 10 million from Fireman's Fund, the primary layer, and then QBE paid out another 5 million, and it was the excess layer. So they had a total of $17 million of general liability insurance with a combination of their underlying general liability policy plus their umbrella. And so with the combination of everything, they had $48 million of insurance. The lesson learned here is nothing's enough. That's all I can say is they are actually fortunate that it's so devastating that it went into receivership, that judges are going to stop some of the frivolous litigation, we hope. But on most situations, it's clearly not this significant and not so widely known across America and the world. And the insurance companies aren't on such a spotlight that they just tender their money like that. So that is just a devastating situation. I do have a few other examples. We have this fairly young woman. She was killed in California community where a tree fell on the carport, and she was in her car getting ready to pull out of the carport, and she was crushed and killed. So that earned a $10 million award. This man was shot inside of his unit when a stray bullet came in his unit, piercing his heart in front of his children and killed him right there in front of them. In New Mexico, there was a $12 million award. We also had a really sad incident in northern Indiana in the Lakes of the Four Seasons where 3 brothers went out on the ice, and they tested the ice, they threw rocks out and all of that, and they made it out. And then on their way back in, one of the brothers fell through, the other 2 tried to come to the rescue. One drowned, one has traumatic brain injury, and the other is left with the memories. There was a $30 million award on that case. And then we have an 11-year-old sitting at her kitchen table in this unit at Traditions HOA in Vegas. She was sitting at the kitchen table when there was a shoot up of this house, which was meant to be a shoot up of a house 2 doors down by 3 gang members, and she was killed. And then there's this. This is a repetition of fires. This property, Windsor Green, had previous fires, and one of them actually burned 26 buildings. And they still didn't take precautions, and therefore when this fire happened, there was a $10 million settlement for liability. So with that, I conclude my part of the general liability, and we're going to move on to Joel, who's going to talk about the good, the bad, and the ugly.
The directors and officers liability policy is somewhat of the misunderstood stepchild in the insurance puzzle for reasons that we can all speculate. People find it very difficult to understand and to see what's going on. So this is the key. Who is responsible to protect, preserve, and enhance the association's assets? That's the volunteer board members. That's the end of the
Joel,
Joel,
you accidentally muted yourself. Sorry.
I said such good things. So this is the association board's obligation to protect, preserve, and enhance the association's assets. It's interesting in a debate that's going on between some various community association insurance nerds has to do with the governing documents, where they also include language to the effect of, maintaining the health and welfare of the association members, but that's for another discussion. So the bottom line is the board is the one who makes decisions. They delegate the decisions, and then that's really their job. That's the end of their job. Okay, next slide. So the board member protection. When somebody sits on the board, and although I get a little scared when I ask this question in front of a large group, I ask board members, how many of you know if you were covered by a directors and officers liability policy? How many know what's included in that policy? And, you know, more often than not, people raise their hand and say, what is D&O? And D&O is the product that protects the board of directors and various other people that are in the line of assisting the board of directors, such as the community association manager, the employees, if any, committee members, if any, volunteers in the generic sense. I think these would be people maybe working with respect to a party or a festival or a parade or whatever they may have. And so we have to know how to protect these people, because you won't get good, intelligent individuals if you're not protecting them. Next. So how do they get protected? They get protected by the indemnification by the association. If you read your governing documents, it's going to have a provision in there, probably in the bylaws and in the declarations, but you can look in the bylaws and it's going to basically say that we're going to provide you with indemnification if you are challenged, sued, or a claim is brought against you for the decisions you make on behalf of the association. Unless your decisions were somehow grossly negligent or willful. That's a real interesting question of law, and someday that's going to get tested significantly. So the next issue is, how do we fund this indemnification? That's really the key. That's the reason we have a D&O policy. That's the good part of this. Go to the next. So the D&O policy is the current. If the D&O policy doesn't provide coverage, and we'll get to that in a few minutes why it may not, the association assets will be the next in line. And next, then they may have to do a special assessment because the association may not have that. They may need a bank loan, and the bank loan, you're not always able to get a bank loan. In Champlain Towers, for example, I think it took the president at the time of the collapse 3 banks and a great deal of assistance before she could get a line of credit to be able to pursue the repairs and such for the tower. And after she got that, after she hired the contractor, it was too little too late. And we could always, you know, rely on a bake sale. Go to the next. This is the insurance puzzle. When I talk about D&O, it's really important to understand where it falls within the directors and within the community associations puzzle. And most of these have been talked to one degree or another. Everything that is in blue or the black at the top, these are liability policies that are going to cover the association and or the board members if somebody sues them for acts that they did in their capacity as either a director or officer or a management company employee or a volunteer. Then we have the various first party coverages, the property, cyber liability, which Russell is going to talk about and scare most of us. Special event policy is a new thing that I've been pushing, because this helps transfer risk from the association's general liability policy. And if somebody's renting a facility or amenity, you can pass that on. But all these decisions come within the directors and officers obligation. Go to the next slide. One of the things I wanted to push, even though the D&O policy is fairly small in the premium picture, it's a critical piece. And it's especially critical for any of you who are sitting on the board, because you want to CYA yourselves in the work that you do on behalf of the board. This was not really a problem until the end of the 90s. Because up until that point, nobody really thought about suing their neighbors on the board. Then all of a sudden, people said, "Oh, there's money there," and they started suing, and it put a big hiccup in the association world for a while until things shaked up, just like everything else. But the blue lines, that's really in the situation of a condominium or a co-op, and that shows you where the property is a significant piece than the general liability. And you can see the percentage for the D&O, the crime, the umbrella, and the cyber. They make up smaller parts. And there are other things such as workers' comp, but the D&O, I wanted you to have a visual of really how relatively inexpensive it is. And one of the reasons we want to do that is because when you're trying to look at getting the best coverage available, and I know Jim and Karen have never heard the issue about it being too expensive. But some places they complain about the cost of insurance. And so as you can see, if you have a 10% increase of the property, that could be fairly significant. A 10% increase of the D&O or the crime or the umbrella or the cyber really is not a huge issue. And that goes to really the fiduciary obligation or the duty that the board has in handling that stuff, but that is the board's duty. Next. So this is the community association risk management puzzle. And why do we do this? I show this because, again, this is the main task of the board. They're there to manage, preserve, protect, and enhance the risk. And this is how they do it to avoid things that commonly could have an impact. Insurance, and the way I look at this is these are all pieces of the puzzle. What we want is we want the pink piece of the pie to be the biggest. We want the self-insured side to be the smallest. And we wanted to be able to transfer by indemnity. You may have various people, other parties that you're dealing with, that you want to be able to have an indemnification provision that you can pass a risk on to them. Risk management is really the biggest. And when we think about Champlain Towers, risk management is really a proactive risk management is really the number one solution, if there is a solution, to the Champlain Towers. And that really involves, no matter what anybody is saying, it really involves bringing in and engaging engineers from the very beginning. Hopefully a developer, a builder will start and do a base point. Otherwise, the association is going to have to do that. And these are obligations that the board has. Yes, it all costs money, and people hate money, hate paying any money. But what they don't realize is by paying this money proactively, for example, 15 million, which they were first told to do the fix in Champlain Towers in 2018. At that point, it was the bill was going to be 9 million. They waited until somewhere in the middle of 2021, before the collapse, it was 15 million. And at that point, it was what is that, about 40% higher of a cost, and nothing ever gets cheaper. And in most things in life, I look at my kids' tuition at the various colleges they went to and compare it to what I paid. I thought I was paying a lot, but it's amazing how things get more expensive. And that happens in the risk management. And the issues that you're trying to manage clearly get worse. You know, decay doesn't get better. I think a lot of us have realized that when we didn't want to go to the dentist, and we eventually go, and you know, we kick ourselves for not doing it earlier. But you really need to understand that that is the board's obligation, the risk management. Insurance is to help pay for the consequences of issues with risk management. Stuff happens. Additional insured is a way you can be on, like when you get a contractor that comes in, you should have a whole system, or your management company should have a system that you direct them to maintain to make sure that you have the additional insured, that the association is an additional insured. And in that case, also, you need to bring in your community association insurance professional, you know, Jim or Russell or Karen, because like with anything else, additional insured, you know, endorsements or certificates, there are a lot of little idiosyncrasies that you don't need to bother your brain with it. You need to use and exploit your insurance professionals, because they don't charge you anything to review things, you know, at least that I'm aware of. And so let's go to the next. So these are the three types of risk. Up until Champlain Towers, you know, I really wasn't focusing on the third one, but wear and tear, when you move into an association and you move into your unit or your house, there are certain things that you know are going to get old and are going to need to be fixed. That's just the way things are. Then you have unexpected perils, and that's what we have insurance for. And then now what's become on everybody's radar is unexpected infrastructure surprises. And these don't really fall within the wear and tear because they're unexpected, they're latent issues that we don't know about. And so that really is what becomes a big problem for us now, because not only do we not necessarily know about it, we haven't budgeted for it. Community associations are budget-driven entities, and they live and die by their budgets. One of the challenges for boards that I've seen over the years, and I've insured over 200,000 of them, is they aren't flexible with their budgets. Sometimes, as we said, things happen and you have to, you know, take care of things. And if you say, well, it's not in the budget, you know, you may have to tweak your budget, because if you don't take care of something like the woman that Karen showed with the tree falling on her car, they knew that that tree needed to be taken down. And so that's how they got the community association really on the hook, because that shouldn't have been there, or they should have put signs, or they should have taken things off until it was fixed. And you know, so you can't wait on certain things, you know. And so people say, well, we didn't budget that in, you know. They really, you know, in some cases they say, well, what we did budget in is we're putting in new hedges, you know, all around the place. And that's what our priority this year is. And, you know, so maybe next year we'll talk about, you know, new balconies or checking our roofs or bringing in an inspector. And then, so the wear and tear, that's what your reserve study does. They basically tell you, we know these things are going to wear out. We think it's going to wear out in this year, and we're going to put away this amount of money. A lot of people say, well, our statutes don't require that we do a reserve study. And even if they do, I think there are 9 states that require a reserve study. Even if we do, we're not required to fund it, and we can waive it. Okay, I think in California, which I think has the strictest, you can waive, you know, the funding of it. And people have a really hard time thinking that they're paying for something that in Florida, you know, I'm going to be dead, let my grandchildren pay for They're going to inherit the building, let them pay for, the upkeep and such. But, now with Champlain Towers, I think the wake-up call is coming that certain wear and tear and certain infrastructure surprises are now really a safety issue, a life safety issue. Next. So these are the different exposures, the types that we have, and people don't necessarily look at these as really what the assets of the association are. The common elements are your assets, the lifestyle. A lot of people live in a 55 plus, like a Sun City or a Leisure World, and that's, people have challenged those, but that's an asset. That's what they want to be. They don't want kids necessarily running around or at the pool. Then the unit owner's value, which is tied into the others, and the board obligation is to help manage the association to protect these risks. Next. Now we look at the good. Okay, as we said, the D&O policy funds the defense of claims against the board members, and if within the definition of insured, committee members, volunteers, community association managers, and or employees. So that's good. Next. The knowledge and exposure regarding claims. One of the nice things about learning about claims, coming to events such as this, is you start learning and hearing about these claims, and you start saying, well, maybe we should have a discussion about better funding of our reserve study. Maybe we should do preventative maintenance. As I believe Jim was saying at the beginning, the dirty word in our industry right now is deferred maintenance. That is what is coming back to bite everybody. And as some are phenomenal at it. Some understand that the association is a business. Some boards understand that they're there not to just wield power and be able to wear their crowns, but they're there to make sure that they manage and keep that asset and hopefully enhance that asset for everybody's benefit. Next. And then the knowledge that the board obtains a lot of times, and I'm sure Karen or Jim or Russell could take you out for a drink and tell you some of the stories about times when they've tried to move a D&O policy from one company to another, and there was $100 difference, but it was really twice the policy that they were moving to, and the people said, yeah, but we really don't want to pay that additional $100. It's never going to happen in our neighborhood. And as we all know, that as soon as they say that, it's going to jinx them. But that is one of the things that really causes problems. So when they learn about these claims and such, they start saying, oh, maybe it can. And as Russell will probably talk about, none of the associations think that they have any cyber liability or data breach exposure. That party's over, and they do. I just finished my first ransomware with a high-rise condominium, and we can talk about that at another time. Next. Okay, the bad. One of the biggest misnomers in this industry, and with respect to the D&O policy, is, and it's not just the insureds, the boards, but it's a lot of the professionals. They all have this notion that if a damage occurs as the result of a decision of the board or the board's conduct, then it must be covered under the D&O policy. And as I tell people is, I'd be happy to cover everything. However, you're not going to pay for it if I cover everything. So what we have to do, and what we've had to do for the last 20 years, is come to that happy medium where we're going to cover as much as we can, minimize the gap between the general liability coverage, our coverage. And our coverage, like the general liability, is going to be followed by the umbrella as well. So next, not all policies are alike. Again, one of the challenges here is if a board member even looks at an insuring agreement, which I think they're obligated to do, they may not understand it, but I think they have an obligation to look at it and have Karen or Jim or Russell sitting in the room and be able to answer any questions that they may have about that, not relying on the management company. There are a lot of community association managers that would put all of us to shame with respect to insurance. However, they're not licensed insurance professionals. And one of the aspects of protecting the assets of the association is working with a professional who has E&O coverage, because they may not be the best, but if they screw up, at least they have E&O policy to go after. But you may have, and I've shown people this, I don't know what policy I shouldn't say, but say you have a farm state policy and you look at the insuring agreement, that's where they give you everything. And then you look at a standalone D&O policy, they look identical and they each have highlighted words or words that are in quotation marks. That means that they are defined. And until you go to the definition section, one policy may say, we're going to cover all the directors and officers if a claim is brought against them during the policy period. Another one may say, we're going to provide coverage to the insured, and insured means past, present, and future directors and officers, the community association manager, the employees, and so on and so on. So right there, that could be a huge problem. And there are other things that they don't have. So you really have to understand, because anytime you don't have coverage, it goes back to that pie piece, that pie chart that I showed you. In that situation, the self-insured is going to get bigger. Okay. And, it doesn't do anybody any good to say, well, it hasn't happened to us, and so why should we spend the money up front? The key reason you need to spend the money up front is because the money that you have that you're managing is not your money. It's the association's money. And your obligation is to preserve the assets. And I haven't, and I'll ask anybody who's on the panel if they do, have they ever seen a governing document where there's an obligation of the board to save money? I would say, yeah, I'll take anybody out for a nice dinner if they can show me, governing documents that say that. That's not their role. That's not their job. Okay, go to the next, right. Not all claims are insurable. That means, so you have claims, you may not buy the policy that has certain things, or there are certain things that aren't insurable, like punitive damages, certain places, or various things that you can't recover. Basically, to be insurable, number one, it has to be covered by the policy, but number two, you have to have an insurable interest in it. And we don't have to get into details there, but those are two things that are a problem. Next. So if the D&O is not covered by the D&O policy, there must be an alternative funding source, because the association still needs to defend and or indemnify a claim. One of the things I always tell people, let's say you're in the middle of Phoenix or Tucson, and you have a single family home in an association, and a piece of the space lab lands in your roof, puts this big hole in your roof, and you kind of like to keep that piece as sort of a centerpiece in your room, and you kind of like the skylight. That's doable. However, if it hits the condominium building and goes to the roof and causes issues, you can't not fix that. And so that's a thing that really needs to be done. And so you need to have a source. And so if the insurance piece of the puzzle is smaller because you didn't buy a policy that had certain coverages, or you didn't have under Jim's policies law and ordinance coverage, which you can call them at 10 o'clock at night, ask them to explain the law and ordinance coverage to you. Next. So these are the sources. We know these: the association's assets, special assessments, bank loans, and bank sales. I can tell you that bank loans seem to be the trending funding mechanism for reserve studies, because when you don't have reserve studies to put on the funds to put on the new roof, you're going to have to go get a bank loan. If you go to any of the CAI events, you'll see that probably the largest, one of the largest business partners there are banks. Next. Yeah. Again, you're not required to be a community association expert. That's not your job. Your job is to be somebody who can bring in the insurance expert. As I said with insurance, call up Jim or Russell or Karen, ask them how much they charge an hour to come sit down in front of your board and explain to them. They probably even would bring donuts, so it's a twofer if you get them to come in to explain that to you. But it's imperative that you know at least an idea, that those puzzle pieces, if they're not addressing all those puzzle pieces, you have to ask them why not, and they'll say because you don't have that exposure, or they may say I don't know. Next. Okay, the ugly. This is the main ugly. It's not before, when I started in this industry, I would go up to people and they'd say, we've never had a D&O claim. Why do we need D&O insurance? And that's not the case. I would go and ask any of your brokers in these areas. And at the end of the day, that really is a significant exposure. Next. Okay, so this is a list of realities and tips. Can you go back up to, so again, it's not if the D&O claim is going to happen, it's when. And so this word, which really causes pain for a lot of boards, being proactive. Okay, that's what Karen was saying. I think that's what Jim was saying. You have to be proactive, getting the best coverage available, spending money sooner or later to fix things. If you don't want to do that, then you probably shouldn't live in a common interest development. Next. D&O policies, more than any other policies, differ in material ways. Make your insurance professional do their work and explain to you why they're recommending one policy over the other. Ask them, have a list of potential issues that you think can come up. And say, is this going to be covered here under the D&O policy? If not, is it going to become covered under a general liability policy? Or are we going to have to pay for that ourselves? Or is there anything we can do to prevent that? Next. Okay, this hurts a lot of people because they hire an independent management company. They say that's their job. That's what they do. But at the end of the day, they're responsible. So if you're going to say, okay, you hired somebody to go out and get you a car, and you gave them this amount of money, and then they come back with a 73 Vega with 3-speed shift, and they don't have any change, you have to understand, because you're there representing the association, spending the association's money. So you have to be participating, and you need to make sure that what's on the application is true. Okay. And this is a shocker for people, but you should read through and have a meeting of your board and maybe do a responsive reading of the application, because you really need to understand what the different things mean. Go ahead, next. Okay. Again, you're not the expert. What you shop for is the insurance professional. You bring in the insurance professionals, you let them tell you why they're going to do the best job for you, what their experience is in the industry. For example, if you know somebody has a CERMS designation, you know that number one, they have certain required experience. Number two, they took the energy and time to get the designation. And so that sort of helps you through. But like with any other expert out there, they may be the best at what they do, but if they just don't have chemistry with the board, then that's an issue you have to decide on yourself. Next. Okay, we're going to go through this because I think I'm going over my time. These are the key perennial favorite claims that we're going to get in our office. And I've touched between 6,000 and 7,000 D&O claims, and enough to say that I'll never see it all. So challenge to the method or failure to enforce governing documents. You can just keep going through them. Discrimination of application of rules to unit owners. Challenge to elections, alleged improper notice. The algorithms for counting up proxies in some associations boggle my mind. I mean, I became a lawyer because I didn't want to have to deal with numbers. Next. Challenge to the alleged wrongful removal of a board member. See, to me, that shouldn't be a claim. You should have to pay them to let you off the board. Challenge to rejection of architectural review application. This is really the number one thing why we came out with the D&O policy to begin with, because people want to make changes. We want to make sure that they keep them in line with the architectural review committee. And the board of directors, and that can be a whole nother seminar, has certain duties and obligations to make certain decisions, make sure that board two terms ago did not approve something that you're now disapproving. And one of the things you always have to keep in mind is most lawsuits now come with a mandatory discrimination allegation. It's not just your breach of this application, but you did it because they're white, they're black, they're Native American, they're short, they're tall, they're Jewish, they're Catholic. People will come up with almost anything to be able to really create an issue. Next. Discrimination and harassment by the board member, association employee, or the management of the company's employee. There is absolutely no reason. And I have a board that I told them, I'm not going to renew your policy unless you're agreed that I can give you an hour and a half training, because I think you guys are a good group, but nobody's ever told you what you need to do. And I think if I can help sort of realign that. I can sort of be your chiropractor for your D&O board. Counterclaim, this is huge. And I think there's only one state out there that doesn't allow a counterclaim to a collection claim. Most people think they're buying time. You file a collection action against the unit owner, and they come back and say, well, I'm not paying it because you're not maintaining the place the way it should be. I'm losing value on my home because you're not mowing, every week. You're only mowing every other week now. And we know that's just buying time and bogus, but that's a claim that gets made a lot. Next. And defamation claims. Again, this is one of these things that should never happen, but it happens. And people don't know how to sit back and sit on their hands and just sort of let people say what they're going to say and not be reactive. Next. Okay, these we go through real quick. Trending claims. Discrimination claims are coming fast and furious. Next. Emotional support animals. Emotional support squirrels, chickens, peacocks, snakes, dogs, cats. We have some help in the federal from the HUD that previously were made by what's his name, the doctor who was in charge of HUD under Trump. He did some really fine rules on this. Service animals, one of the things that I tell people is, in this day and age, do not even consider rejecting an application for a service animal or emotional support animal if you haven't spoken to your attorney. It's going to cost you $250, $300, but it's such a sticky wicket now that in some states it's almost strict liability if you refuse it. So Airbnb, this is becoming a problem because a lot of governing documents are silent on short-term rentals. Some don't have it, and then all of a sudden we find out that there's 6 units in the association that are doing Airbnb, and finally somebody's complaining. Cyber liability, I'll leave that to Russell. Next. Data breach, I'll leave that to Russell. Challenge to biometric scanning devices. People complain about anything. We'll just pass over that one right now. Next. Smoking, cigarettes, and marijuana. I mean, this is, with the cigarettes, there's some issues. With marijuana, it's a twofer, because if you try to tell them, well, you can't smoke, and then they're going to turn around and say, but, I was told by my healthcare professional that I need to smoke to maintain my sanity or to relieve the pain and such. And it gets into a lot of people, backseat drivers, who tell how else they can take marijuana. Next. And these are the key claims that I deny on a daily basis: bodily injury, including emotional distress. Next. Property damage and loss of use. That's not under the D&O, as Karen said. Construction defect. Those first 3, the good thing about Champlain Towers is I stopped insuring it in 2014. It didn't stop them, though, from tendering it to us, even though it's 7 years ago and it's a claims made policy, which means that the claim for that has to be made during the policy period, and our policy was gone. But we had to, and these are the 3 reasons. There are 4 reasons. 1, untimely, but in addition to that, bodily injury, property damage, and construction defect. And going back to what Karen was saying with respect to all of them tendering their limits, I think a lot of that had to do, as we said, it was all a business decision, and a lot of empathy, a lot of people coming to conclusions that have just not panned out. People have been blaming, and they sued all the board members. Only one of the 7 died. I don't know where the other 6 were. That's interesting. But the board was very vigilant in trying to get them to do this. The first board quit. The second board, they finally got an agreement, but one of the reasons they couldn't fund it is, since it was more than 10% of their annual budget, they needed a supermajority, 75%, to be able to increase it, and they couldn't get that from the unit owners. So everybody presumed that it was all about the directors and officers. And the good news is it really wasn't about the directors and officers. The bad news is they're going to sue them anyway, and that's why you have D&O insurance, because, if it's something other than one of these 3 things, we may be able to defend you. These 3 things were not. So there are a lot of situations where, like a breach of contract or such. Next. Oh, yeah, this is the big one where we just said timely file a claim, and we don't have enough time today because I've talked too long on certain things. Claims of indemnification of attorney fees and costs, that's just not recoverable unless it's part of a judgment, then it may be. A claim of indemnification for remedial measures. For example, one of the big things in D&O, and this is a difference between a lot of the package policies from some of the writers, direct writers, for a long time didn't provide coverage for non-monetary claims like challenging architectural review issues, a removal of somebody from the board. But now we do provide defense of that. But if there are costs associated with it, indemnification, like they say, you have to put in a ramp for pursuant to ADA, we'll defend the board on that issue. However, we're not going to pay for the ramp to be built. Next. Okay, and this is a big one that really people need to understand. The claim by the independent CAM versus the association, or the CAM suing CAM company under D&O policy. These will never be covered under any D&O policy that I'm aware of on the market. Basically, we're not going to defend the management, we're going to defend a management company when third parties or business partners or people that are in contract with sue the management company, but we're not going to sue them if the association brings a claim against them. And the bottom line there is we would have to pay to prosecute that action, and we would provide the independent community association manager who we are suing. We're paying for them to defend us against to defend them against our lawsuit. So next. Okay. These are things I'll just quickly go through and then I'll be done. Protect the attorney-client privilege. This is huge, and you should probably have an attorney if you haven't, like Mr. Nordoff or somebody else come in and really indicate what these pitfalls are, because it's a huge issue with board members. Next. Emails between and amongst board members. Since I'm doing this virtually and I'm not where anybody can come up and hit me, I think that this in and of itself is a breach of your fiduciary obligation. We can debate that another time. Next, another reason with the emails, and a lot of people don't think about this, is if you're using your personal email or you're using a business email and it gets involved in the lawsuit, your boss very well could receive a subpoena, and the subpoena is requesting all of your emails for the past year and a half. First of all, your boss is going to not be very happy because he's going to have to hire an attorney to review those before they produce them. Then there's going to be things in there that you may not want your boss to see. And a similar thing, would be with respect to your personal email. Do you want somebody in the litigation who may very well be your neighbor getting your personal emails for the past year? There are a lot of things that people just don't think about or go through. Next. And this is treating the association as a business. It is. Next. Leaving personal emotions off the table. That's just critical. Next, I think that's it. Not listening to the association's attorney. Yes, that you should get lashes for. And then this is, if the D&O coverage is part of a package policy, make sure that you review the definitions, exclusions, and conditions, because they're not going to be the same as what Karen or Jim are going to give you. Okay, next. We're going to stop here because maybe sometime I'll come back and do claims examples for you because they are fun. And this way we can, I've already used more of my time. So, and this is my favorite part. If all else fails, you can burn down the building. Okay, next.
Thank you, Jim, Karen, and Joel for your parts. You can consider me the insurance topic dessert and save the best for last. So I'll try to push it along a little bit. I think we went a little bit over on our time, so I'll go through this a little bit more rapidly. But if you have any questions, we can certainly take those afterwards. Basically, we're going to go over what is cyber liability, who needs it, what you might look for, and key underwriting considerations. Next slide, please. So basically, cyber liability, it responds to any liability that's imposed through the transmission of electronic data. It can also respond to a breach in a breach of loss of personally identifiable information in paper files. So you want to be sure that your policy actually will respond to any way that information can be transmitted, or it can be accessed or authorized where authorization is not allowed. So next slide, please. So there's basically 5 parts to cyber liability policies. Network security is by far the biggest one to which most people are concerned. Cyber liability policies were actually first created back in the 1990s. A lot of people consider cyber liability new. Well, in fact, it's been around for 30 years. When it first came out, it really only responded to online media and errors in data processing. First party coverages weren't really an issue at that time. The Security Breach and Information Act in California was enacted in 2003, and that required notification to impacted individuals when there was a breach to data. Almost all states quickly followed suit, and that really became where cyber liability policies were necessitated. There's really two primary reasons for exclusions in an insurance policy. One of them is because it's simply of a catastrophic nature, and really insurance isn't a mechanism that can address those types of exposures like nuclear war or something of that nature. And the other is because the exposure is more adequately addressed in a policy that's specifically addressed for that exposure. And that's the case with cyber liability. So network security, that's the coverage part that most of us are primarily concerned with. It responds to data breaches, malware infections, viruses that are on your computer, cyber extortion, ransomware, and it deals with the first party costs, including the legal expenses, the forensics that are designed to examine how your system or your network was accessed and prevented from happening again. It can deal with the costs surrounding negotiation and payment of ransomware, your data restoration, and the costs involved with notifying impacted parties and monitoring those individuals' credit so that they're not further impacted by the loss. Next slide, please. Privacy liability. This is the liability imposed when your breach basically triggers a privacy law violation, and then people can sue under their sue to be made whole for and that will defend against such costs. It'll include the settlement costs, legal expenses, and fines or penalties imposed by regulatory bodies. Network business interruption, that's the next. This doesn't apply so much to community associations, but for people that have a lot of revenues that's gained through their network, and where an extended shutdown or interruption of your network could cause a loss, that's where this agreement would come in. Media liability, this is personal injury, often excludes cyber liability and transmission of data. This picks up the libel, slander that you see in a liability policy under your personal and advertising injury. This is the advertising injury, and it can respond to amounts. It can respond to losses out of advertising and the social media posts and that type of thing within the, again, cyber platform. Next slide, please. And then errors, omissions. This one also is a situation where this more applies to IT professionals. But again, this is for errors and omissions in rendering or failure to render your services, and speaks to what they can do in that situation. So who needs it? Really, everyone has an exposure. We're all completely reliant on our computers and our networks and our networks these days. And so anyone who has a lot of records that has personally identifiable information is reliant on their IT systems to conduct their operations. You can have contractual obligations that are subject to regulation. And it's as Joel and others spoke to, it's the board's diligence, due diligence to protect the assets of the board. If there's a loss, where's it's going to come from? It's either going to come from the funds of the association, or you're going to look to an insurance policy. Next slide, please. So oftentimes people say, you know, the management company collects my data, so why do I need it? So if any of these situations apply, the association itself has the need for this coverage. If the association collects personally identifiable information, this is important. This includes an individual's first name or first initial and last name, in combination with one or more of the following: financial account number, credit card number, and security code, access code, or password. It's does the association own the owner's data that is provided to the management company? Does the association use a payment portal? Does the association use third-party processing service? And does the management company contract require that the association indemnify the management company? Any of these situations results in the need for this coverage. Next, please. So there's studies done every year. Right now, they're indicating that an average cost of a per record breach just for the notification and credit monitoring expenses can be up to $250 a record. So as you can see, a 100-unit association, per two-member household, that's $50,000 that could be realized just for notification expenses. Where's that going to come from? Yeah, if it's not by cyber liability, then it's back to the bake sale. So next slide, please. So what to look for? Again, these are the important aspects of what to look for in a cyber liability policy. You do want to reach out to your insurance professional. What are the limits of insurance? Are they adequate? Have you assessed your need? How have you determined what your limits are? Are there sub-limits? There's a lot of sub-limits oftentimes within a cyber liability policy, and they often apply to the coverages that oftentimes are most often accountable for the claims, such as social engineering and false pretense, which I'll touch on a little bit more. And will your umbrella lie over it? Oftentimes it will not. Can you back up just a second? So what's covered, are all your forms of media, everywhere you're transferring, is everything covered by it? Does the company pay first dollar, or will it reimburse you? This is an important aspect. Most people prefer the pay on behalf. What other resources do you get with your policy? Oftentimes you have hotlines you can call if you think you might have been breached. Is the insurance company reputable? Check the AM Best rating. That's a good source to see if they're financially strong and big enough to support their contract. And then, is there coverage for social engineering, false pretense? This is being tricked into giving the information away by which they access your account. This is not always just part of the automatic coverage, and is something that's an absolute must for your policy, as many claims fall under this coverage part. Next, please. So underwriting considerations. This is one of the most rapidly changing coverages in my 30 years of doing business. 3 years ago, again, people were just, questioning even the need. And now the carriers are questioning if they're willing to offer terms. When you fill out the application, that's a warranty. You need to consult with your IT professional or your management company's IT professional to make sure you're answering the questions correctly. Multi-factor authentication, that is an extremely important situation. Many carriers are now requiring that be in place to even offer terms, and some of our carriers are non-renewing loss-free policies that have had no claims whatsoever if this isn't in place. So if this is not part of your IT system, you want to check with your IT professional and get that in place. You must disclose all prior incidents, anything you know. If they find out while investigating a claim that there were incidents that were unreported, they could potentially deny a claim. You should have a cyber response plan. You want to know what to do if something happens and where to go. The basis of your limit is often how many records you have, multiplied by the cost per record, and determining what kind of limit you have. Your employees. Employee training is of the utmost importance. Karen sends me emails at 3 o'clock in the morning all the time asking that I rush $100,000 into her new account that I never even knew she had before. So you just simply need to be aware that if something looks fishy, pick up the phone and call the person and make sure it's accurate. And then what type of data you collect. Most of us aren't concerned with health information, but if health information is included, the cost per record can jump substantially. Next, please. So can it happen to me? It does. Joel just spoke to a claim that he was involved with recently. We were just involved in a funds transfer claim that hit $70,000. Ransomware is responsible for 41% of claims, according to a cyber claim 2020 report. So ransomware is quickly the reason why this is being reassessed by the marketplace. The premiums have gone up 50% since this time last year. Yet you can still get affordable coverage for as little as $500 for a small association to at least have some benefit of the coverage should an incident occur. So again, I'm sorry if I rushed through this a little bit more than I might have otherwise, but I wanted to be considerate of your time. I think that's it. Next slide. So if there's any other questions, by all means, put them in the chat. We'll be happy to respond now or at some time in the future, but we appreciate the opportunity to have brought this information to you. Thanks.
Yes, so please post your questions in the Q&A or the chat. If you have any. I thought there was some questions in here. I'm not sure what.
I've got them, Kath.
You got them?
There's a few in the Q&A. Yeah.
Yes. Okay, so the first one is, I'll throw this out to Jim. How does a board go about making sure their insurance costs will go down, and maybe by how much, if they mitigate all aluminum wiring in their buildings? Question mark. Am I correct that the mitigation is done at every outlet?
Yes, great question. So I'll give you an example of what we just went through within the last 2 weeks with an association. The underwriter required the Alumicon method of remediation to all light fixtures, outlets, sockets, everything. Anywhere where there's an electric connection that's going to meet up with an appliance or whatever it might be. We had to have a letter from the electrical contractor stating that the project was complete with a list of units that had been completed. And in this case, because it was in St. Louis County, the county actually did an occupancy inspection on every unit upon the completion. So we had a certificate. We did not give all that to the underwriter, but we, just in case, did have a certificate on file on every unit stating that it had been inspected by a third party after the contractor had completed it. It was an arduous process, and with this particular community, it was about an 18-month process. But again, their insurance costs went from around $100,000 to $50,000, and I believe the project was around 125, 150 grand. So the ROI, I mean, why spend it on insurance when you could be spending on improving your community and also enhancing the life safety of your community, which kind of kicks over to Karen's segment of the general liability portion of this. I really believe now is the time that communities need to look hard at this due to what's going on in the insurance marketplace.
And with what Jim said, we can't state without knowing where your insurance is placed right now that you don't have wonderful premiums. And we can't state that it's absolutely going to go down. We can tell you that if the carrier finds out you have aluminum wiring, chances are you're going to be paying a lot more. And, but we can't state anything without seeing it. Thanks,
The next
Jim.
question was for you, Karen, so I won't let you read it to yourself. The question is, Karen, so are you saying that when the insurance companies paid out their limits, that the homeowners can no longer get any money from those insurance companies?
And that's correct. So we're talking about Champlain Towers. As soon as James River paid out their $2 million, they no longer have a duty to defend. So once the limits paid out, there's no more defense. So all these lawsuits that are going on, and same with the umbrella. Why would the property carrier pay out when there's that possible exclusion that Jim talked about? Well, guess what? If they try to deny and say, well, the board knew of the decay, then there's going to be lawsuits challenging, well, did they know of the exact decay that brought down the building? So once they pay out their limits, there's no more legal problems for the insurance companies. So where does that leave the owners, the board members, the owners that died? 48 million shared amongst these owners is nothing for those that lost their life, severely injured, all of that. We do know that the receiver plans on the sale of the land to be a big part of what will go to the owners. And I believe it's at 100 million to 150 million. I believe there's some dispute right now. That's one of the ways that they're going to get some more money for the owners. The other ways are that they've sued 35 other entities, including the city, the municipalities, the engineering, the builders, all going back. So they'll try to get money from other entities. But yes, once you pay out the policy limits, no more defense is owed.
Next question. Oh, I'm sorry,
go
go ahead. Go ahead.
No, you please, all you.
I see them now. So next question, I believe, is to Russ. If a board member's computer is hacked and homeowner information is accessed, will cyber insurance cover the cost of repairs to the board member's computer?
It could do that. It's not the computer. It will pay to restore the data that's lost. It depends. I mean, typically a computer itself isn't necessarily isn't damaged in the incident, but it will help to restore the data and basically make them whole where they were before the loss. Correct?
That's correct, but that's the least of that board member's problems. I mean, we need to look at the liability issue that what the hacker got. The laptop can cost what, $2,000? So I think we'd really be more worried about what information that hacker obtained and what they do with it, and that's where they need the liability.
And property insurance will cover the loss to the laptop itself, but it's the data that's lost that's the big concern.
Yeah, the key issue that I'm running into in that, with respect to that, is generally they won't pay for the board if her computer, for all intents and purposes, is the association's computer, and that's where all the information is stored, and they underwrote based on that and what firewalls and encryption was on that, then there may be coverage. But generally, because most of that we're finding is the property management companies are handling most of the data and financial transactions, on behalf of the association, and the associations don't have their own system, their own network. And so we're finding that, because I'm doing this for a lot of management companies, and I'm getting the information from the management company with respect to that, which makes the brokers' lives a lot easier, because we just come out and say the unit owner is not handling any of this.
And it can also be a problem with mobile phones as well, because again, those are used for both personal and business. And if it's the individual's phone and they don't have the proper protocols, that can also be a major source of breaches.
Well, the next question or comment we had is anyone else's head spinning? So whoever wrote that, and anyone else that might be feeling that way, that's part of why we put on these tough topics. So please add your questions to the Q&A, and we'll be sure to try to get to them in the time. The next question after that was, is there such a thing as too much insurance coverage wherein it serves as a beacon for someone to sue the HOA because they have so much?
I can take that, Stephen. That's such a thing I hear a lot, whether it be from a homeowner or a business. Well, they're going to sue us for as high as the insurance limits are. So if I have a $25 million umbrella, they're going to try and get the 25 mil. While it is true, it's possible during settlement time that they're going to be able to get the whole 25 mil. But if it goes to jury, the jury, and Stephen, please add to this, the jury doesn't get to know your insurance limit. So you can only have 10 million umbrella and the jury awards a $30 million verdict. So there's no harm in having there is no such thing as having too much insurance. I mean, look at Champlain Towers. Stephen, you want to add to that?
Well, I'll let Joel, since he's on the panel and also an attorney, if you'd like to go on to that, Joel.
Yeah, what I found when I was early in my community association career, I was using the argument primarily because I only had $1 million umbrella policy, that if you have 50 million, they're going to sue for 50 million, because if their child fell off the balcony and, it's worth, if there's $1 million that they can get in a week, that's what their child was worth. If there's 15 million, they would go for that. And, it's, on the other hand, the more time I've spent, again, you're a fiduciary, and the assets and the money that you are spending is, again, not really yours. You're not protecting your individual assets, you're protecting the associations. And so in that regard, especially in our industry where the umbrella policies are relatively inexpensive, I think it's, again, as Karen said, I don't think you're going to have too much.
I think this next question's for Jim. With the non-profitability in the insurance industry in the last few years, have denials gone up to save money?
Listen, the insurance contract is the insurance contract. So the insurance companies are legally obligated to pay for what the insurance contract mandates them to. Now, I'll put an asterisk on that. If you have a big roof claim, is a roofing engineer going to come out and scrutinize that a little more, saying, you know what, there was a lot of pre-existing damage before we even wrote this policy, or we actually think this happened 5 years ago, not this year. Yeah, I do think more of that's happening. And, it's not a mandate for adjusters to go do that, but I think insurance companies are sensitive to this deferred maintenance issue. And insurance companies don't want to be paying for a community's deferred maintenance. They want to pay for an actual insured claim. And sometimes discerning between the two is very difficult and does take rigorous engineering reports and everything like that. So I know a lot of managers and boards out there have been going through this over the last couple of years, especially on the roof and siding issues. So yeah, I mean, I won't say it's just like a blanket statement, but if you've got deferred maintenance, expect extra scrutiny of your property claims.
Unless anyone has anything else to add on that, I'll move to the next question, which was, how do I convince my board or boards to get cyber liability coverage, even though the management company actually houses all the data and we have our own cyber, I guess, do we have our own cyber liability?
And this goes back to the slide about who owns the data. Does the association own the owner's data that's provided to the management company? Are they contractually obligated to indemnify the management company for losses the management company has as a result of housing their association's data? Some of these are legal questions and may not fully be known till after the claim happens, but that's what you have to assess to determine if you need the cyber liability coverage or not. Most associations, and most of the time, you do have some responsibility for the ownership of the data that's collected on your behalf. And so most of the time there is some exposure to almost every association.
Yeah, I would approach it basically starting from the fact that whether anybody can sue, I mean, anybody can sue anybody for anything. And when you're sued, you have to be defended. And as most of us know, the defense fees and costs tend to be much more severe than even indemnity. That's one issue. So they're going to, just like the management company is named in all the suits against the association, I think it's going to go the reverse. And another issue is some of the concerns go to data breach statutes. And in most of the data breach statutes, they indicate that if you have a third-party vendor who is managing or control of products of information on your behalf, you still, in a lot of states, some have loosened this up, you could still be responsible, and there could be fines and penalties. And under the data breach policy, the fines and penalties are covered, which is unique because it's going to be expressly excluded in all other liability policies. And the one thing I just wanted to add one comment to what Stephen brought up about the, I just experienced this, is with the support the breach services. The carrier that we had involved in this ransomware, they were within an hour. We submitted the claim on behalf of the association. Within an hour, their breach coordinator was on the phone. Within 2 hours, they had the computer forensic expert available, and there was an attorney on hold to handle if it turned into an actual negotiation, which fortunately the ransom was not pursued by the people. So I think those services, because who knows who to call or what to call. I mean, this management company, this was a general manager of a high rise. They had their act together and they had things done, and they did an incredible job. And, you know, they isolated the issues. It still cost almost $30,000. You know, they had to pay their $1,000 deductible. So that's something that I think you really want to make sure when you're shopping it with your broker, that they make sure that those services are top of the list.
We only have one question left, so I'll pose it to the group, and if anyone's got more, throw them on there, although we're about out of time. Is anyone surveying high-rise condos to see if they're getting reserve studies and funding them?
Everyone will have an opinion on this, but it depends on what state you're in. Whether there's a statutory requirement for specific types of communities to have reserve studies and whether they have to be funded. So Missouri is a bit of the wild, wild west. There's nothing being policed here. And I would say the percentage of communities that have reserve studies is much lower than in other parts of the country. Illinois is a little bit better than us due to some of the state law requirements. The policing of it, again, is going to depend on jurisdiction, but there's not a lot of that going on. And that's why really the boards ultimately are the ones responsible. They're the ones who have the duty, as set forth in the governing documents, to protect and enhance the assets of the association. And it's hard to do that without a reserve study.
With that, one of the things that we think is going to come out of Champlain Tower South, and Jim is on the task force as well as Joel and Russell, is that they're asking us, and some of the company people are on the task force, what would make good underwriting sense going forward? And one of the major things is reserve study and look at the financial health of the community and if they have reserves put aside. So can this be an underwriting criteria of the future? We hope so. Be careful what we wish for, but we hope for financial health for the communities that they do get on board with reserve studies and funding them.
Being a little pessimistic, I think Champlain Towers is going to be substantially a one-off situation. I don't think we're going to be seeing these collapses. On the one hand, I think people are going to look a little closer at their buildings and maybe bring in an engineer. What we're really pushing is for reserves specialists when they issue their reserve study, that they indicate if they recommend that an engineer be brought in because they're concerned about certain areas. And I'll ask you guys, since you deal with it more than I do, a lot of the property carriers do inspections as well. And if they see, something that may cause problems, I think they're going to catch it before, the association's going to catch it. But then again, I don't know if they're just doing visual from the outside or not.
It's every property insurer is different. I think you'd all be shocked at how little inspections actually happen. When they do, they tend to be headaches, and they tend to happen because there's questions about a particular community. But we are seeing, especially for older communities, an uptick in inspections. And I know Karen and Russ can attest to this. A lot of non-renewals are issued because as a result of non-compliance with those recommendations. And usually it's age of roofs, decaying decks, things like that.
I think that's all the questions that we had, unless I'm missing any. I don't see any. I wanted to thank all our presenters, our program coordinators, our sponsors. You guys are awesome. I also wanted to tell everybody about our next program. We're actually doing one in person this year. On November the 3rd at the Lodge in Tapare, we're going to have Debrief to Win. Top Gun instructor, retired Colonel Rob Cujo Teschner will teach how accountability is a fundamental component of teamwork, drives increased performance and satisfaction, inspires, motivates, and drives excellence. So we hope you can join us in person. We're super excited if you can. If you can't join us in person, we will be picking up our webinars in January. So our program committee met yesterday, and we have a great mix of a little bit of in person, a little bit of webinars. So we hope to see you. I'm going to share the link to sign up for Debrief to Win in the chat, so you guys can sign up. Thank you, everybody. We hope you have a great week, and thanks for joining us. Bye, everybody.
Bye. Thanks.